Quantitative Easing and Proposals for Reform of Monetary Policy Operations by Scott Fullwiler and L. Randall Wray. Section 3. Quantitative Easing and its Critics. In the previous section, we argued that the impacts of quantitative easing 2 on private spending will come through effects on interest rates, and they are likely to be very low. This means that the critics of the Fed who are concerned about inflation are mistaken. While some have likened quantitative easing to helicopter drops of money, that clearly is not taking place. Particularly in the case of quantitative easing 2, the Fed actions merely replace treasuries with reserves. While that might have a small impact on interest rates, it will not induce much spending. Further, the pressures today are overwhelmingly deflationary given the state of the economy. Quantitative easing 2 could even add to deflationary impacts due to the effect on interest income. Recognizing this, some critics argue that today's policy will cause inflation in the future because quantitative easing will leave banks with massive quantities of reserves. Yet, the Fed can and will reverse course in the future if inflation pressures build. When the economy recovers and when there are signs of inflation, the Fed will begin to push short-term interest rates up, as it has done for decades, whenever there were signs of inflation. It will also begin to drain excess reserves from banks by unwinding its own portfolio. This will be accomplished by selling its assets back into the banking system. For each bond sale it makes, it will debit bank reserves dollar for dollar. It can do this at a measured pace, if desired, so that these sales need not affect yields. However, if desired, the Fed can proceed more quickly, selling assets at a pace sufficient to push prices down and yields up. The process will continue until banks hold no excess reserves. From our discussion of interest rate elasticities above, it will be clear that we doubt such actions have a decisive impact on aggregate spending, but we wish only to emphasize that the existence of more than $1 trillion of excess reserves in the banking system will pose no challenge to policymakers when they decide to reverse quantitative easing and to raise interest rates to fight perceived inflation pressures. It should also be clear from our discussion that we are not supporters of quantitative easing, but we believe that the inflation argument is entirely erroneous. Those making the argument simply do not understand monetary operations. Finally, given that the quantity of reserves banks are holding has no impact on their ability to create loans or to otherwise finance economic activity, there is in fact little economic necessity for the Fed to drain excess reserves even if inflation pressures do build. The Fed is perfectly able to raise the federal funds rate target even in the presence of massive excess reserves, given that the target rate is now set equal to the rate paid on excess reserves banks are holding. All the Fed needs to do is raise the rate it pays in line with the increase of its target rate, forcing market rates up to overnight funds. Forcing market rates up on overnight funds. There have also been reactions, especially from abroad, by those who fear that quantitative easing will cause the dollar to depreciate. Following our discussion above, there is little justification for such fear. Quantitative easing will have minimal effects on long-term interest rates and on domestic spending. Hence, there is little reason to believe that it will have direct impacts on capital flows or current account deficits. To be sure, exchange rates are complexly determined and no economic models have proven successful at forecasting their movements. If quantitative easing has any impact on the value of the dollar, it is likely to come through effects on expectations. We believe that expectations ultimately must be grounded in something, and if quantitative easing has as little impact on the U.S. economy as we believe to be the case, then there are no grounds for believing exchange rates will change. but announcements by U.S. policymakers can have at least temporary impacts. We do wish that the Fed and Treasury would issue an announcement that it is not the intention of U.S. policymakers to depreciate the dollar. We believe that all of the pressure Treasury Secretary Geithner is putting on some of our trading partners to appreciate their currencies is a mistake, because it is tantamount to arguing that we want the dollar to depreciate. This, in turn, is seen by the rest of the world as a U.S. intention to try to export its way out of its crisis. That is intentional adoption of a modern mercantilist policy. We do not believe that such a strategy is in the interest of the United States. It would raise the cost of imports. Nor do we believe that it would be successful. It would almost certainly lead to retaliatory measures. Many historians believe that the Great Depression of the 1930s was worsened by exactly such a tragedy. Policymakers must instead look to domestic policy measures to end our crisis. Finally, a potentially negative, albeit temporary, effect of quantitative easing might be that prices in other financial markets rise, even in the absence of fundamental reasons for this to occur, besides an anticipated fall in Treasury rates. That is, the discount rate used in valuations. This would be largely in response to anticipated increases in economic activity, or even anticipated increases in inflation that might raise commodity or equity prices. Rising equity prices are usually a good thing, but the 1990s showed this isn't necessarily the case if the increase is inconsistent with underlying value. We view these effects as necessarily temporary, since, as we explained in this and the previous section, there are no actual transmission mechanisms for quantitative easing to directly affect the real economy, and thus affect fundamentals related to valuations, beyond a potential decrease in interest rates, which, as explained, may not even occur.